Welcome to our exploration of three fundamental concepts in economics: interest, rent, and profits. These terms are often mentioned in discussions about how money moves and grows within an economy, but what do they really mean? In this video, we'll break down each concept, look at how they function, and see why they're so important for both individuals and businesses. Whether you're a student, a professional, or just curious about economics, understanding these ideas will help you make sense of financial news, investment decisions, and even everyday transactions. Let's start by setting the stage for our journey into the world of economic returns. Interest is a term you've probably heard in the context of loans, savings accounts, or credit cards, but in economics, interest refers to the cost of borrowing money or the reward for lending it. When you deposit money in a bank, you earn interest because the bank uses your money to make loans. Conversely, when you borrow money, you pay interest as a fee for using someone else's funds. Interest rates are influenced by factors like inflation, central bank policies, and the overall demand for money. Understanding interest helps you make better decisions about saving, borrowing, and investing. Let's dive deeper into how interest actually works. Imagine you lend $1,000 to a friend and they agree to pay you back with 5% interest after 1 year. That means you'll receive $1,050 in total. The extra $50 is your reward for lending the money. Banks and financial institutions operate on the same principle but on a much larger scale. They collect deposits, lend out money, and charge interest to borrowers. The difference between the interest they pay to depositors and the interest they charge borrowers is a key part of their profit. Interest rates come in different forms. The most common are simple and compound interest. Simple interest is calculated only on the original amount, while compound interest is calculated on both the original amount and any accumulated interest. Compound interest can make your savings grow faster, but it can also make debts more expensive if you're borrowing. Understanding the difference between these types is crucial for managing your finances effectively, whether you're saving for the future or taking out a loan. Interest rates play a huge role in the overall economy. When rates are low, borrowing becomes cheaper, which can encourage spending and investment. On the other hand, high interest rates can slow down borrowing and spending, helping to control inflation. Central banks like the Federal Reserve adjust interest rates to influence economic growth and stability. These changes ripple through the economy, affecting everything from mortgage payments to business investment. Now let's turn to the concept of rent. In everyday life, rent usually means the payment you make for using someone else's property, like an apartment or office space. In economics, rent has a broader meaning. It refers to any payment made for the use of land or other natural resources. This could include farmland, mineral rights, or even the electromagnetic spectrum used by telecom companies. Rent is the price paid for exclusive access to something that is limited in supply. Economic rent is a special term that refers to payments made for resources that are in fixed supply. For example, if a city has only a few prime locations for businesses, the owners of those locations can charge higher rents. This extra payment above what's needed to keep the resource in use is called economic rent. It's different from regular business profit because it comes from owning something unique or scarce, not from taking risks or providing services. Let's look at some real-world examples of economic rent. Imagine a famous beachfront property. Because there's only so much beachfront, owners can charge high rents simply because of the location's scarcity. Another example is a talented athlete who earns more than others because of unique skills. In both cases, the extra earnings are considered economic rent, since they're not the result of extra effort or investment, but rather of owning or possessing something rare. It's important to distinguish between rent and profits. While both involve earning money, rent is tied to ownership of scarce resources, while profits are the reward for taking risks and running a business. For example, a landlord earns rent from property, but a store owner earns profits from selling goods and managing operations. Understanding this difference helps clarify how wealth is generated and distributed in an economy. Profits are the financial rewards that businesses earn after covering all their costs. In simple terms, profit is what's left over when a company subtracts its expenses from its revenue. Profits are essential for business growth, investment, and innovation. They also serve as a signal to entrepreneurs and investors about which activities are most valuable in the economy. Without profits, businesses would have little incentive to take risks or improve their products and services. There are different types of profits in economics. Normal profit is the minimum amount needed to keep a business running, covering all costs including the owner's time and resources. Economic profit, on the other hand, is any profit above this minimum. Economic profits indicate that a business is doing better than average, often because it has a competitive advantage or operates more efficiently than others in the market. Calculating profit is straightforward. Subtract total costs from total revenue. However, in practice, businesses must account for many different expenses such as wages, rent, materials, and taxes. Accurate profit calculation is crucial for making informed business decisions, planning for the future, and attracting investors. Profits also play a key role in determining whether a business can survive and grow in a competitive market. Profits are closely linked to risk. Entrepreneurs and investors take risks when they start new businesses or invest in new products. The possibility of earning profits motivates them to innovate and improve efficiency. However, not all ventures succeed and losses are always a possibility. The relationship between risk and reward is a central theme in economics, shaping the behavior of businesses and individuals alike. Let's compare interest, rent, and profits side by side. Interest is the reward for lending money, rent is the payment for using land or resources, and profits are the reward for running a business. Each plays a unique role in the economy, helping to allocate resources, encourage investment, and reward innovation. By understanding these differences, you can better appreciate how money flows and grows in the world around us. Banks play a central role in the world of interest, rent, and profits. They collect deposits, lend money, and help businesses and individuals manage their finances. By setting interest rates and providing loans, banks influence economic activity and growth. They also earn profits by charging higher interest rates to borrowers than they pay to depositors, making them key players in the financial system. Landlords are the main recipients of rent in the economy. They own property or land and lease it to others in exchange for regular payments. The amount of rent charged depends on factors like location, demand, and the quality of the property. In some cases, government policies can also influence rent levels, especially in cities with high housing demand. Entrepreneurs are the driving force behind profits in the economy. They start businesses, develop new products, and take on risks in hopes of earning a return. Profits reward their efforts and encourage further innovation. Successful entrepreneurs often reinvest their profits to expand operations, hire more workers, and create new opportunities for others. Interest also plays a key role in personal savings. When you deposit money in a savings account, the bank pays you interest as a reward for letting them use your funds. Over time, this interest can help your savings grow, making it an important tool for building wealth and achieving financial goals. On the flip side, interest is a cost when you borrow money. Whether it's a mortgage, car loan, or credit card, you pay interest as a fee for accessing funds you don't currently have. The total amount you repay depends on the interest rate and the length of the loan. Understanding how interest works can help you make smarter borrowing decisions and avoid unnecessary debt. Rent isn't just about apartments or offices. In agriculture, farmers often pay rent to use land for growing crops or raising animals. The amount of rent depends on the fertility of the land, its location, and market demand for agricultural products. Landowners benefit from rent, while farmers must factor it into their costs and pricing strategies. Resource rent refers to payments made for the use of natural resources such as minerals, oil, or forests. Companies that extract these resources often pay rent to governments or landowners. The value of resource rent depends on the scarcity and demand for the resource, as well as the costs of extraction and regulation. Innovation is a major source of profits in the modern economy. Companies that develop new technologies or products can earn higher profits by offering something unique. These profits reward creativity and encourage further investment in research and development, driving progress and economic growth. Interest rates are closely linked to inflation. When inflation rises, central banks may increase interest rates to slow down spending and keep prices stable. Higher interest rates make borrowing more expensive, which can reduce demand and help control inflation. Understanding this relationship is key for anyone following economic policy or planning major financial decisions. In cities, rent plays a big role in shaping urban development. High rents can drive businesses and residents to seek more affordable locations, influencing the growth and character of neighborhoods. Governments sometimes intervene with rent controls or subsidies to make housing more accessible, especially in areas with rapid population growth. Competition is a key factor in determining profits. In highly competitive markets, profits tend to be lower as businesses vie for customers. However, companies with unique products, strong brands, or efficient operations can earn higher profits. Competition encourages businesses to innovate, cut costs, and improve quality, benefiting consumers in the long run. Interest rates have a big impact on investment decisions. When rates are low, borrowing to invest in new projects becomes more attractive, leading to economic growth. High interest rates, on the other hand, can discourage investment by making loans more expensive. Investors closely watch interest rate trends to decide where and when to put their money. Scarcity is at the heart of rent in economics. When something is limited in supply, like prime land or rare resources, its owners can charge higher rents. This principle explains why city center apartments or beachfront properties are so expensive. Scarcity drives up the value of access, making rent a powerful economic force. Profits act as signals in the market, guiding resources to their most valuable uses. When a business earns high profits, it attracts more investment and encourages others to enter the market. If profits fall, resources shift elsewhere. This process helps ensure that goods and services are produced efficiently and meet consumer needs. Credit markets are where borrowers and lenders meet, and interest rates are the price of credit. These markets include banks, bond markets, and other financial institutions. The level of interest rates affects everything from consumer loans to corporate bonds, shaping the flow of money throughout the economy. Sometimes, rent arises from monopoly power. If a company controls a unique resource or technology, it can charge higher prices, earning economic rent. This is why patents, copyrights, and exclusive licenses can be so valuable. Monopoly power can lead to higher rents, but it can also reduce competition and innovation if not regulated. Profits are not just important for business owners, they also matter to shareholders. When a company earns profits, it can pay dividends to shareholders or reinvest in growth. Shareholders look for profitable companies as a sign of good management and future returns, making profits a key driver of stock prices. Managing debt is all about understanding interest. Whether you're a business or an individual, keeping track of interest payments is crucial for financial health. Paying off high-interest debt quickly can save money, while smart borrowing can help fund important investments. Good debt management relies on knowing how interest works and planning accordingly. Governments often step in to regulate rents, especially in housing markets. Rent controls, subsidies, and zoning laws can all affect how much rent is charged and who can afford to live in certain areas. These policies aim to balance the interests of landlords and tenants, but they can also have unintended consequences like reducing the supply of rental housing. Profits are subject to taxation by governments. Corporate taxes, capital gains taxes, and other levies reduce the amount of profit businesses and investors keep. Tax policies can influence business decisions, investment strategies, and even where companies choose to operate. Understanding how profits are taxed is important for anyone involved in business or investing. Interest rates are a powerful tool for managing economic growth. By raising or lowering rates, central banks can influence how much people borrow and spend. Low rates can stimulate growth during recessions, while high rates can cool off an overheating economy. The careful management of interest rates is a key part of modern economic policy. The value of land is closely tied to the rent it can generate. Prime locations with high demand command higher rents, which in turn increases land values. This relationship is central to real estate markets and urban development, influencing where people live and businesses operate. Profits provide the fuel for business expansion. When companies earn profits, they can reinvest in new products, open additional locations, or hire more employees. This expansion creates jobs, increases output, and contributes to overall economic growth. Profitable businesses are often the engines of progress in any economy. Interest affects many aspects of personal finance, from credit cards to mortgages. Understanding how interest rates work can help you make smarter decisions about borrowing, saving, and investing. Whether you're planning for retirement or just managing monthly expenses, keeping an eye on interest rates is always a good idea. Rent can have a big impact on social equity. High rents can make it difficult for low-income families to find affordable housing, leading to inequality and social challenges. Policymakers often debate how to balance the needs of landlords with the goal of providing fair access to housing for everyone. Profits are important, but so is social responsibility. Many businesses today aim to balance profit-making with ethical practices, environmental sustainability, and community engagement. Socially responsible profits can lead to long-term success and a positive reputation, benefiting both companies and society as a whole. Interest rates don't just affect local economies, they also influence global markets. Changes in major economies' interest rates can impact currency values, international trade, and investment flows. Investors and policymakers around the world pay close attention to interest rate trends in countries like the United States, Europe, and China. Technological change can affect rents by making some resources more valuable and others less so. For example, the rise of remote work has changed demand for office space, affecting commercial rents. Similarly, new technologies can create new forms of economic rent, such as exclusive access to digital platforms or intellectual property. Profits are a driving force behind economic development. They encourage investment in new industries, infrastructure, and education. As businesses grow and succeed, they create jobs and raise living standards, helping entire communities and countries prosper. Profits, when used wisely, can be a powerful tool for positive change. A healthy economy depends on the right balance between interest, rent, and profits. Each plays a unique role in allocating resources, rewarding effort, and encouraging innovation. Policymakers, businesses, and individuals all have a part to play in maintaining this balance, ensuring that the economy works for everyone. Wrap up: interest, rent, and profits are more than just financial terms. They are the building blocks of our economic system. By understanding how they work and interact, you can make better decisions in your personal and professional life. Whether you're saving, investing, running a business, or simply curious about how the world works, these concepts are essential knowledge for navigating the modern economy. Thanks for joining us on this journey through the core ideas of economics.